Good morning, Emily. Are you going to ambush me with terrible tax advice again?
No, and I think those were great examples of things people want to know about.
All right, well, I will take your word for it. What are we talking about today then?
When it makes sense to max fund your retirement accounts, rebalancing your portfolio, and financial planning internships.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, these are three semi-related things. No, they're not. They're not related at all. It's fine.
Okay,
Uh, you can try to stitch them together, but we'll just see how it goes. All right, hit me. What do we want to hear about? I'm going to guess 401ks first.
yes, I was reading a book this week and it was talking about this particular author's personal perspective. And he said, I don't think it makes sense to max fund your 401k in a lot of situations. And there are several reasons. And I wanted to talk about that today. His first one being, the cost and the drag on returns and all that of being able to do that. Can we talk a little bit more about that piece?
Sure. So give me a little bit more detail here because you just said like the drag and the costs and all that, but like that's very vague. So be more specific. What kind of drag and costs are we thinking of here?
Well, he was a little vague. It was a very short chapter, but I kind of honed in on that and got obsessed with it. He was talking about, depending on where you work and what plan they have and this and that, there's fees that you're paying, and you maybe don't have access to like the best investments through your workplace. And there's other accounts and investment vehicles and things that might have better options for you. And because of all those things, you shouldn't max out your 401k through work.
Sure, that's always possible. So, particularly if you work in like a small company or a small business, you will probably, as a participant, have higher plan costs than if you worked for the federal government or like Apple or something. And that's just going to be a combination of either explicit program fees passed on to you. So, there could be like record keeping fees or platform fees that you have to pay out of pocket. And then also, it's very common, particularly in small plans, for there to be financial advisors who are participating in the plan as advisors to the plan sponsor, and often they're going to get paid as a percentage of the plan assets. And those percentages can get very small as the plan grows, but often, like on dollar one, it might be like 0.5% or something like that, which is not nothing. And then also, a lot of plans, particularly for brand new startup plans, will offset the administrative costs of the plans by having revenue sharing in the products. Where, for example, you have something like an R1 share class instead of an R6 share class, and the cost to you as a participant might be equal to a whole percent or more in terms of having the exact same investment fund, but one that has much higher costs, which are then being paid over to the plan record keeper, platform, and vendors to offset the cost so that your plan company or your actual employer doesn't have to pay, let's say, several $1,000s a year for the plan platform. Now, I can argue that those costs are really unnecessary, and there's a lot of vendors that have much lower costs that even a small business could afford instead of passing it on to their participants. But that's sort of the problem he's elucidating, is that some plans are bad and not all plans are made equal.
Oh, so the advice there is more so look at your plan and figure it out. Don't just blindly invest in it.
Yeah, and in that particular context, it's very normal for like a brand new startup plan in industry terms to cost the participants all in something like 1.5, 2%. That's really high from just a rate of return standpoint. If you're targeting, let's say, 8% a year and you're paying out 2% in fees and expenses, yeah, that's a lot. The offset then is, is there a match? Is there an employer contribution? Is there some reason you should be participating up to the minimum at least to get the free money? Because then even if the plan costs are, let's say, 2%, if you put in your 100% of a dollar and the company puts in their 100% of a dollar, even at a 2% fee, then you're only losing 4 cents on the dollar you put in and the dollar they put in, at least on that matching component. I think it's very different, and I think this is more the point he's trying to get to, when you're contributing above matching amounts, where then suddenly you don't have the free money to offset the costs. And at that point, then it does make sense to do more of a fair assessment between the options and costs of your plan versus what's out there on the open market that might be both cheaper or more flexible.
Hmm. Okay. So highlighting the importance of doing your homework and reading everything. Okay, but his other main point I have to get to, because this one I think is far more interesting to talk about, is he was saying, okay, if you're putting it in these plans, then your money is locked up until retirement. We all know this, but he kind of highlighted that as a much bigger deal than a lot of other materials that I've read. How concerned do people need to be about the fact that their funds are all locked up till retirement? There's benefits to that, and sure there's downsides, but how do you weigh the importance of that?
I think the only scenario in which that actually really matters is an early retirement scenario, because like your 401k is there to fund your later non-working years. So if your crisis here is, well, I want to save for my retirement, but I also really want to buy like a very expensive car. And so, saving for my retirement is cutting into my car budget. Like that's just very backward thinking. But I don't really think that's the point he's trying to make. I think the point he's trying to make is asset location and tax advantages are important, but sometimes, overemphasizing saving for retirement can mean foregoing present opportunities and quality of life items. There's also some advanced tax planning and strategy around having Roth money, pre-tax money, having non-qualified money. We have a client, for example, who's been retired for the last 5 years, who's essentially had a 0% tax rate because while they saved a lot of money in 401k and retirement, they also saved a lot of money outside of 401k and retirement. And so they've been able to live on essentially a 0% long-term capital gains rate for the last several years. So, I mean, there's definitely some advanced kind of planning and strategies there. I think the challenge for a lot of folks is unless they have really high financial self-efficacy, that it's going to be very difficult for them to actually efficiently and effectively save not only in their company retirement plan, but in other places and stay on top of the investments and stay on top of the efficiencies and so on, such that while it might be more optimal on like a true math tax planning standpoint to have some money in your 401k and some in a Roth IRA and some in a brokerage account and so on, not a lot of people have good financial self efficacy to actually implement it consistently and actually get the benefits of doing it right.
So you wouldn't necessarily advise people in general to do that, but what about these specific scenarios? I mean, I know you kind of hate it when say, well, what about this one single situation and they nitpick something, but like there's someone in my life that I know and they want to save for retirement and take advantage of all the tax advantage accounts possible and the growth and all these things, but they have someone in their life who's disabled that they might need to take care of one day. And she's like, I want to have access to my funds if I need it. I don't really know what my future looks like as clearly as other people maybe do. What do you say to someone like that?
I mean, this is just something where you need to balance your current consumption, your midterm potential consumption, and your long term consumption. This is actually sort of a perfect example of where life cycle hypothesis and then the behavioral life cycle hypothesis came out, which is there's sort of an assumption in financial circles that everybody is somehow magically capable of calculating their present and future needs efficiently. So for somebody like your friend, they've got to really balance out like, okay, if I can afford to save 10% of my income, if I didn't have these obligations, I'd just save it all for retirement, but I have these obligations. So now I need to sort of plan for and discount how much of this is for shorter term or midterm future expenses where I need to care for this family member versus providing for myself and my own retirement. And that's a balancing of priorities question. But I think in that particular sense, then it's not so much about the pros and cons of a 401k or a Roth, and it's much more about your just shorter term timeline needs.
Right. And maybe taking a closer look at that behavioral piece that you talked about, where it's like, if you're going to do it in this kind of non traditional way, you need to be very intentional about it and really keep track of what it is that you're doing and why.
It's important to do that as well. It's also just important to contemplate that like there's always a crisis of the week. I can always think of a reason in the short term that almost anybody should stop saving for retirement or should cut back severely on it. I'll use myself as an example. My wife and I want to completely redo our backyard. We want to finish our basement. We're probably going to end up spending like $150,000, $200,000 on these projects over the next couple of years. And boy, maxing out my 401k sure is slowing down my progress towards those goals. And that's just something where I have to acknowledge, like much as I would love to get it done faster, and I could even get it done faster by using something like a HELOC and borrowing against the house, I know that long term, the most effective thing I can do is save towards those goals separately from my retirement, keep funding my retirement, and don't take on debt to get there faster. Because even though it'd be a quality of life item, it's then going to cost us more over the long term to have borrowed to do it in the first place. So, I mean, that's just sort of the thing you have to keep in mind is competing priorities sometimes create a problem. That's where I honestly do like retirement plans and the degree of penalties and so on and disincentives that they have to not take out of them. I don't love the penalties, I don't love the taxes, but they do create a genuine roadblock for people squandering their future wealth. Because we also talk to a lot of people as financial planners who are like, yeah, I didn't work or have a serious career for the first 10, 15, 20 years of my life, or like I did, but then I became a stay at home parent until our kids grew all the way up into like high school and graduated and went to college. And now I'm getting back into the workforce and I haven't saved the whole time. And my spouse could only afford to save the minimum because we were living on one income. Like there's all sorts of scenarios like that where people really do squander their future wealth for short-term problems, and sometimes it's necessary, but sometimes it's just the easy way out.
Well, sure. But I think it's hard for them to realize how big of an impact there is. Like you've said before, you're a financial planner. You know exactly what redoing your backyard is going to do to you short term and long term. Is it just a matter of them not realizing it? That's the whole reason that they're doing that?
I think there's two things. One, hyperbolic discounting, which is just the problem where we're bad at compounding math. So you hear about like the latte effect. Like if you just didn't buy lattes and you put it in your retirement instead, you'd have $1 million. Well, the same thing happens with buying that car or redoing the basement or tearing out your kitchen or something like that. Like your kitchen renovation might cost you 60 grand, and that's a lot of money. But compounding over decades, that really is like a $500,000 decision, right? Or $1 million decision, depending on how big it was. And people are bad at that math. The other thing is, and this just got some decent research on this, people are bad at empathizing with their future selves. Like they rationally, logically know, like one day I will grow old and I will need to have done things during my working years to provide for future me. But we just care a lot more about present me than future me. And so there's been a whole bunch of studies where like they've taken sort of like aged up pictures and digitally enhanced pictures of people and asked them to like set their retirement savings rate versus just like putting a mirror in front of them and letting them look at themselves and picking their retirement rate. And the people who can see the aged up version of themselves tend to save more and do more for that person because it humanizes their future selves a little bit. But it's just sort of hard to empathize with 75-year-old Dan. That's just sort of how human nature is, despite the fact that we do logically know that it's just us in the future, and future us will depend on what we do today.
That's interesting. In that study where they showed like an aged photo of yourself, did they notice if it's kind of like a short term effect having seen that picture once, or did it kind of change their behavior in the long term to have thought that through and seen that?
I don't think the study really did any follow up with that. So it was just more about like, hey, pick your savings rate and it's just you, and versus pick your savings rate and like this is you in the future. So they were really just looking at sort of that effect. Although, if I wanted to sort of torture other studies on the subject into relevance here, there tends to be a pretty strong anchoring bias for people in retirement savings and a lot of inertia bias in that people tend to save what they have been presented with in the first place. So like if your company says, hey, when you sign up for the 401k, you default put in 5%, a huge number of participants will just do the 5%. And if you say it's 10, they'll do 10. And if you say it's 3, they'll do 3, and they often will not change it unless they run into financial challenges later where they suddenly need to free up cash flow.
Interesting. So it's really, really important to set it up correctly the first time and then leave it alone.
Yeah, I mean, it's where in our 401k, your default enrollment rate is 10%. And if I could make it 20, it'd be 20, but it caps out at 10 on the system we're on. But also then from the same standpoint, when you're advising clients, hey, you're setting up a retirement plan, not just for yourself, but for your employees, let's really talk about like what the default rate is. And sometimes they don't want it to be high because they don't want their employees to enroll at all, or they don't want to pay a match. But if they've got the capital to get it going, hey, have your employees sign up at 10. And if they don't want to sign up at 10, that's fine. But then they have to manually opt out of paying in 10 or paying in 5 or whatever it is and dial it down. And then on the other side of that, same thing for employers or even just the self-employed without employees. A lot of them make a mistake where they will always do their retirement savings in arrears. So certain retirement plans are very effective at letting you calculate your maximum contribution looking backwards. So every spring they're looking at their prior year and they're saying, I want to put in the max and I'll put in 20, 30, 40, whatever it is. And that's fine. That's good tax planning, but they really probably should have just been contributing some amount all year long to go ahead and try to fund it and build it up over the year instead of doing it in arrears, because some of them are bad at doing it in arrears where they'll do it one time and then next year it'll be a quote unquote bad year. So then they won't do it again. And then they'll just sort of get off the train and they have a hard time getting back on.
Yeah. Well, it's definitely tempting. And if you got an end of the year bonus to do something fun instead of just putting it in your retirement account and feeling like you didn't get anything for right now.
Yeah. And at the end of the day, Yeah, this is sort of the funny thing, right? The inertia effect and the anchoring bias often make it so people put in what their employer incentivizes for them, but employers are no less prone to this bias, right? If they start on day one by contributing every paycheck or every owner's draw that they take, that's probably better for them than they are trying to do it in arrears via tax planning.
Well, there's plenty to think about there. I'm going to pivot to my next unrelated topic, so it's going to be a smooth transition, Dan.
This is transitional material. Carry on.
Okay, now I want to talk about the frequency of which you should rebalance your portfolio. Again, this is pulling from that book I read, so I've had a very interesting week. But first, I think we should probably talk a little bit about what that is for listeners and why we do that and kind of what that all means.
Sure. So rebalancing is the activity of looking at sort of the pie chart view of your portfolios. Let's just keep this super simple. Let's say you have a 60-40 portfolio, which is a very classic style of portfolio in which 60% of your money is in US and international equities, big companies, small companies, but you're buying stock. So it's made up of Apple and Microsoft and all that sort of stuff. And then 40% of your portfolio is made up of US Treasury bonds or corporate bonds or fixed income assets like that. And when you set it up initially, you set it to be 60% equity and 40% fixed income. Well, in a good market year, the equities are probably going to outperform the fixed income. And so, in that particular condition, then by the end of the year, the end of the quarter, the end of the month, whatever period you're looking at it, you might have drifted from 60-40 to, let's say, 65-35 or 70-30. And that represents an overweighting and an increase of risk, or vice versa. In a down year, you might have wanted to have 60% in equities, but equities are just taking a brutal pounding. And so, even though your fixed income hasn't necessarily grown or done anything special in that environment, maybe your equities have shrunk to 50%, and by proxy, then your fixed income is now also 50%. So in those scenarios, rebalancing is the act of resetting your portfolio, selling anything that's outgrown its original position to buy things that have shrunk from their original position to try to keep your overall levels of risk and reward aligned. There's also advantages like things like tax loss harvesting that can be done as part of this process. There's risk management benefits, and there's also sometimes sort of arbitrage opportunities where something has gone down, something has gone up, and so we're selling high and buying low on a periodic or repeated basis.
Sure. Okay, that's a very good summary there. So let's talk about the frequency then. In the book that I read specifically, he was kind of arguing that it doesn't matter how frequently you do it, monthly, quarterly, annually, whatever. In the long run, the results are going to be the same. So, annually has some advantages you can do with other tax related decisions, was kind of his main point, which is why he does it annually. But how do you go about deciding what's best for you? Because I don't think you're necessarily on the same page with that.
So, well, and what's best for me is not what's best for everybody. So let's just put that pin in the topic right out of the gate. So what we tend to do is we tend to approach rebalancing with two sets of criteria, not just one. The first one is that we don't actually use time as our delimiting factor in rebalancing. So we don't force a rebalance every month or every quarter or every year for clients. We analyze regularly, no less than monthly, whether a rebalance is appropriate for portfolios. But the actual triggering and inciting thing that will cause a rebalance to happen is tolerance bands around the original position. So in my original example, you had a 60-40 portfolio. And without any sort of tolerance bands, if the portfolio was even, let's say, 61-39, at your rebalance, you would drag it back to 60-40. Well, tolerance bands sort of allow you to say, hey, look, on a relative basis, I want to have, let's say, a 10% or 20% tolerance for drift in the portfolio. So in that context, then let's say it's 20%. If a position was supposed to be 10% originally, then a 20% tolerance would mean that if it goes below 8% or it goes above 12%, that's a triggering event that's going to cause a rebalance. But if it's anywhere in that 8 to 12 range, it's not going to trigger a rebalance. So that's sort of an approach where we can say, look, timing is important, and it makes sense to periodically check and have a system for seeing what kind of where you are in the overall structure of your portfolio and whether it's kind of drifted too far. It helps to have those quarterly or annual or monthly benchmarks to go ahead and check in. But I think what's more important is how much tolerance you have for drift, because ironically, unless all of your assets are growing perfectly in tandem at the exact same rate of return in the exact same time periods, drift sometimes is just, hey, the portfolio is doing well and it's making money. And if I'm just cutting it off every week or every month just because, then I might be cutting off the thing that's in the middle of sort of a momentum moment where it's been growing and appreciating rapidly, and I'm cutting it off quickly or earlier on than I necessarily would have if I gave it a little bit more leeway to grow.
Okay. Do you recommend doing it that same way for people that are self-managing and maybe don't have the time and resources that we do to constantly be looking at that portfolio?
I recommend, so this becomes a question of tools and technology. Some, for example, some 401k plans have just time-based rebalancing available. And so it'll just automatically rebalance you in that just 60/40 example I gave, every quarter or once a year or something like that. Some plans don't have that. And some plans are advanced enough to have not only the band tolerance thing, but also the timing thing. Some only have the band tolerance thing. And then some are also set up where they just send you an alert when it happens, but they don't automate the actual trading. So I highlight those differences because to some extent, if you can't automate it, I'm really, really skeptical of saying like, yes, you, the listener, should go out and do this on your own. We have tools. We have really powerful software that allows us to do this across tens of millions of dollars and hundreds of accounts simultaneously, and that makes it very easy for us. But these are tools that most of the public doesn't have access to. There are some platforms. You have some robo platforms like M1 or Betterment or Wealthfront that provide you with tools like this or do something like this for you automatically, and then that's great. You'll pay for the tool, you'll get the service, you get the benefits of it. But if you're just like gonna bust out an Excel spreadsheet once a month and kind of see if your stuff has drifted too far, and then do the math on what you need to sell and buy into, I don't hate that, but I'm really worried about your ability to deliver on it consistently. Because what if you take your family to Disneyland the week that you would normally be doing it this month, or you are in the hospital during the quarter where you normally do it, or you normally would do it during tax season every year, right? You're doing it the same way that author is suggesting doing it once a year, but this year you've got a lot going on and you just sort of forget. So I'm really cautious around anything you can't automate in this particular sense. It's not to say you can't be involved in it and want to pay attention to it, but anything that is solely reliant on you having it on the calendar and manually doing it, I'm always just really skeptical because human beings are really bad at habit building.
That's true. I would definitely agree with that. Do you have recommendations for people then around how to do it? Because, of course, you can sell things to kind of keep it more in line and within those, say, 60/40 parameters. But there's the alternate way where you can just buy back more of whatever has kind of decreased in your ratios there and rebalance that way. Do you have a preference versus one for the other?
Not really, because I think it's always facts and circumstances dependent. It's going to matter whether it's qualified or tax advantage money versus taxable. And for that matter, do you want to do rebalances as frequently? What if it's a short term capital gain instead of a long term capital gain when you perform your sale? There's just so many factors that go into that decision that I really don't want to give sort of a blanket answer here, because what I'm worried is that somebody's just going to be like, well, Dan said do it this way. And despite the disclaimer at the end of the episode that you shouldn't do this stuff without professional help, somebody's going to do it. And then they're going to be like, wait, what is this tax bill? Damn it, Dan. So I'm going to sort of punt on that one and say at the end of the day, it is really facts and circumstances dependent. And to some extent, if this is the first time you're hearing about it or the first time it's making sense to you, maybe don't put your life savings in the hands of a technique you've never heard of or never done before.
That's true. Podcasts can be very educational, but maybe you do a little bit more research than a single episode before you make some big moves.
That would be a great idea.
Now that's advice you can stand behind. Okay. Okay, we're on to my third then and final topic. We're switching gears completely. Once again, I want to talk about financial planning internships. We, of course, are going to be hiring an intern here for this summer. That's something we've been talking about around the office here. For those who are interested in entering the world of finance, maybe, and other than reading the book you've already written about this, do you have any general advice for people that are looking to get a financial planning internship?
Yeah, recognize that not all internships are made equal. So just keeping in mind that the vast majority of internships in the financial planning world are actually just sales jobs. And I hate to break it to you because that's not like a super fun thing to hear. But the vast majority of jobs in the financial planning world are also just sales jobs where the deal will look something like this. You're going to come in, you're going to interview, you look good, you sound good, they like you. They're going to say, great, next steps. Here's an Excel spreadsheet. Fill in 100 or 150 or 200 people you know and their phone numbers and their emails and whatnot, and maybe some other extraneous detail. And then we're going to hire you on for the internship. We're going to spend the first week or two getting you like a life insurance license or something. And then you're going to cold call those people all summer long or all semester long and try to sell them life insurance or mutual funds or something like that. That is a very, very common internship. So I say that, I give you that context to say that getting a good internship is very competitive because the thing I just described, they'll take all of you because they don't pay you anything. They don't pay hourly, they don't pay salary, they pay you commissions. And so in that context, some schools screen for this and block for this, but a lot of them don't. And so in that context, then, if you don't want to just sell stuff to mom and dad and your neighbors and your friends from high school, then you're going to have to do a lot more due diligence. So I'm just setting the stage there first and foremost.
Okay. So, other than researching what your role is actually going to be like at the internship, would you argue that they should do a paid versus not paid? Obviously, paid is better, but there's the endless argument of like, well, you're learning an experience and you're gaining all this knowledge and blah, blah, blah. You should just take the unpaid.
I mean, definitely go for the paid first from the standpoint that it is work and you should be paid for your work. And even if you are gaining knowledge and experience, if you have to drive to the office every day, then it's costing you something to do that job. And there's also opportunity costs, right? If you take an unpaid versus a paid. But that said, there are not enough paid internships for everybody in financial planning. So getting a paid internship, great first step. If you can't get it, unpaid if it works for you. And even then, I don't love it just because there's issues there. But in that particular sense, internships are hugely important because they're going to allow you to experience not only the work and day to day of being a financial planner, but they're also going to help you accrue hours towards your CFP certification. And they're also going to make you much more competitive when you do go for jobs. It's also very common for a lot of firms to do an internship to hire plan, right? The very first associate planner from this firm, Samantha, was an intern who was so good as an intern that even though it wasn't the plan to do an internship to hire, I made her an offer at the end of the summer anyway. So there's definitely circumstances where they may explicitly say this is not an internship to hire program, but there may be an opportunity. And alternatively, some firms, that's how they hire new people, is they do internships, and if they like you, they'll make an offer for you to come on when you graduate. So, as far as paid versus unpaid, experience is everything. That is one of the biggest things because a lot of people say they want to do this job, but they never have any experience. And then it's incredibly hard for them to get a job. So much as I want you to get paid for your internships and for your time, if it's a choice between no paid internship and a unpaid internship, I'm gonna say go ahead and take the unpaid, much as I hate to say it.
Yeah, because it is tough to get into the industry. I don't know if any of the listeners have read your book about it, but it details quite a bit of that. For our internship, I know that it is paid. How do you decide on the rates for that and everything? Knowing you, I'm sure you just look around at market rates, but I looked it up here just in Colorado, and there's a pretty wide range of what people are offering. How did you settle on what we pay?
So, very typically, just to give sort of listeners the broad context, internships in financial planning firms very typically pay something like $15 to $20 an hour. In our particular case, our rate is actually just sort of salary driven. So, it's actually just equivalent to our lowest tier of salary that we pay for staff. So, for context, the sort of hourly equivalent is about $27 an hour. And then in that particular spirit, then month by month, it's about $4,700 per month of the internship. And that's because it's a full-time internship. You're going to be here 40 hours a week. You're going to be in client meetings. You're going to be here 9 to 5 and so on, maybe a little bit before, maybe a little bit after to attend certain events and see certain things. But that is a sort of fair market rate for what that is. Now, again, there's a lot of unpaid interns. We could just say we're going to have 4 summer interns and none of them are paid. And we would get some kids from upper middle class and rich families who would take that opportunity. But at the end of the day, we want financial planning to be accessible. And so people need to be paid a fair wage. In my mind, then a fair wage is no less than anybody else at the firm would be paid to work here if they were actually working here full time, long term.
Well, I'm sure the intern we choose will appreciate that. For other people who are in the position that you are, where they're hiring interns and staff, can you talk a little bit more about how you decide what work you're going to have them do? I know you've told me in the office this week on the side that they're going to be shadowing, following around myself and you and other people at the firm. And you're not going to do that thing where it's like, hey, go sit in the corner and do data entry for the next 2 weeks, where you're just kind of delegating the work that no one else really wants to do. You're really having them involved and learning as much as humanly possible, even though that's way more work for you. Why do you do it that way?
Because A lot of internships are famous for being like the go get coffee internship, or like go file stuff, or go like make copies. And like, yeah, at some point, you might need to go get your own coffee as an intern, or you might need to scan or file something because that's just what's required. But I think the best thing an internship can do is make a job either a hell yes or a hell no for somebody, and it shouldn't be because it was miserable. Some jobs are just miserable on their own. I'm thinking of investment banking, where everybody gets paid a ton of money, but like they work 100 hours a week, and it's absolutely terrible for that reason. Financial planning is a great field. So what I want an internship to do is really help somebody dive in and get immersed in what being a financial planner is, what working in a financial planning firm is. And working in a financial planning firm is not fetching coffee all day. It is not filing all day. It's not scanning all day. It's not just pure data entry all day. It's a huge variety of activities. So I want somebody to come into it and get to see it and feel it and experience it, and be able to walk away from it saying like, wow, this was awesome. I would love to do this. Or like, it's too chaotic. I would really rather have like a very rigid 9 to 5 where I just have a very specific structure and it's not very variable. It's okay. Of the interns that we've had in the firm over the years, I think only one has actually gone on to be a financial planner. All the other ones are in finance somewhere, and that's fine, right? Because that's part of the learning experience of being an intern, is finding out like, hey, this is amazing for me, or like, hey, that was great, but I also did an internship in something slightly different, and I think that was better.
Okay. Well, that somewhat answers my next question, because I wanted to know, why do you bother with interns? Because your big piece is, education and helping people get into the industry, yada, yada. Why don't you just hire someone like you did with me or with some other people at the firm and, still get to do the education piece and really be side by side with them? But there's a higher likelihood that one day you'll get something out of us because we do work for you, full-time, long-term, theoretically. Interns don't, and you know that right out of the gate. Why do you still do interns?
Well, I mean, there's a couple of reasons here. Number one, it is just cheaper to give people some experience and a taste of financial planning for 2 months versus for a year-long thing. Secondly, I'm not big on part-time work. Obviously, there's lots of people who need part-time work, want part-time work, but I'm just not very big on saying like, hey, you're going to be hired here full-time, but it's actually only 20 hours a week, and you're going to fit it in around your classes or something like that. So we've always sort of focused on a summer internship that's a full 40 hours a week because we want them to be immersed in what this future career might look like. Whereas most financial planners are not part-time people. So there's the learning experience there. To the longer, sort of arm of your question, there's a world in which we could say, hey, we're going to do 6 2-month internships a year. And, that'll cost us the equivalent of one full-time person, but then we can help 6 people get experience. That's something we may do in the future. I just don't think we've ever quite had the bandwidth and focus and kind of circumstances for that to make the right kind of sense for us.
All right. Well, that certainly clears it up for me.
All right. Well, then, in turn, it sounds like you've been doing quite a bit of learning this week in terms of the reading in the book and looking into internships and all that. But I'm still going to ask you, what is the thing you've learned in the last week or two that you think is the most valuable for our audience to learn from?
Acceptance, because a large portion of what we do, to me, it feels like, is giving advice, and then people do not always take the advice. And that can be very frustrating for me. I'm an action person. I like moving around and doing things and being busy. And it is very hard for me to say, hey, we should do XYZ. This is why. And you can see that it's a good idea. And they're like, yep. I mean, do you want to do it? And they're like, no, I don't though. That is hard for me. So that is what I've been learning recently, is you can't care more about something than the person themselves who it actually directly affects.
Yeah, and that's a huge, huge issue. The way I always phrased it when I was getting started is that if the numbers were enough, everybody would be rich, because the math is easy, right? Save, invest, just do it, right? Have a little shy of the LaBeouf moment and just scream at every client, just do it. Max fund your 401k, buy a smaller house, whatever. People would be really well off, but people want different things. They're different people. They're in different situations, and so the sort of golden rule for financial planners: you can't care more than your client does.
Yeah, that has been apparent to me recently in several scenarios. So that's actually my bigger takeaway, despite all the reading I've been doing.
Hey, it's good life experience.
It certainly is.
The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.